We talk about value versus growth all the time as if it's a real asset class, and I've always had grave doubts about whether you can lump these companies together at all. I'm wondering if the whole value versus growth story is sort of irrelevant at this point. I mean, Tim mentioned banks and energy. See, this makes some sense to me. Banks are obviously rallying because yields are going up. Net interest income should be going up. That's a significant part of large banks' revenue base. So that makes sense to me. Energy stocks should be going up. The whole country, if you look at refiners, they're up 30% in the last few weeks. The whole country's acting like they're going to go on vacation in the first or second quarter of next year. Well, that makes some sense to me, too. I don't know if value versus growth makes a lot of sense at this point. Should we just sort of drop that moniker?
I really agree with you, Bob. I do think that's an oversimplification. And really, I think the whole industry has been moving away from value, even though it's a great simplifier. And I also like to look at on an industry basis. I think the bottom line is a company has to transform itself continuously to take advantage of technology trends, or there is no value at the end of the day. So Tim mentioned GM. That's a perfect example. Mary Barra there is trying to transform GM into a much more asset-light, technology-driven kind of company. And everyone needs to do that. Even asset managers need to do that. So I think financials and energy will get a reprieve. But if a big bank is not investing in technology, into the payments, the digital payments infrastructure and everything, they won't make it in the long term.
Yeah, I'm glad to hear you say that. I have been tired of the value versus growth story for a long time. I understand it's got a long history. I understand there's research going back to the 1930s about it, and I understand Graham and Dodd and all of that. But I don't quite understand why people think it's an amazing asset class. I prefer sectors that might be called value over that. That's enough for the editorial for the day. Doug, let me ask you, go back about the active management. How much more do you think this has to go? So we have $5 trillion in ETFs. I think that's a big milestone. We just hit that. But how much do we have in mutual funds? Still like 20 trillion, something like that, more than that? Do you see a significant move in 2021? I mean, is this the start of a big move away from mutual funds into ETFs?
We think so. I mean, the opportunity set of ETFs has always been there. We understand their tradability, their lower cost infrastructure, the ability for an active manager to package their same alpha, but put it in a wrapper that's going to be much more tax efficient and have global distribution opportunities. So it really is a better mousetrap, if you will, for an active manager. And now they have a solution to be able to put into place where they can still do active stock picking. They can still manage their own money without investors seeing what they're doing every single day, with that veil of transparency, if you will, that ETFs typically provide. And so now it's an opportunity to come to market. We're seeing it already. I mentioned there's 15 of these ETFs that are already in play, but the pipeline, I will tell you, is dramatic. And so I would expect in the next 6 months, we'll see double, maybe triple the number of semi-transparent ETFs come into play. And it's the largest active managers in the world. They want an ability to tap into this growth market. They're seeing ETFs grow dramatically, and it's a better way to shield their alpha.
Yeah. Yeah, and we see some very successful mutual fund people moving into the active management ETF space. We're waiting for Dimensional Fund Advisors, a very successful, very well thought of organization on Wall Street, waiting for them to make that move over. They've already announced that. But give me some dollars. I mean, what could we attract $1 trillion, $2 trillion next year? Could we be sitting here at this time next year saying the ETF business is an $8 trillion business, and $2 trillion of that is active management? I'm pushing you a little, but stop being so abstract. What does it really mean?
It's always hard to predict the future, right, Bob? I mean, none of us has that crystal ball, but we do believe we're planting a forest, if you will, and maybe it's not a 6 month or a 1 year time frame, but we do ultimately believe a large portion of the actively managed funds industry will move into the ETF for all the aforementioned reasons. So, yeah, I don't think it's unreasonable to say there'll be $1 trillion in actively managed ETFs in the next year or two. I think that's a reasonable goal. We're seeing it happen. We're seeing people in the works of working to convert traditional mutual funds direct into an ETF. So if conversions start to take off, you can imagine the dollar movement very quickly. And even if it's not a conversion market, you'll probably see a lot of clone strategies come to market, people who are running very successful, large, actively managed mutual funds, but want to do so in an ETF wrapper. So again, it's more about opportunity, and it's more about a growth story than anything else for active managers to be able to use ETFs.
Yeah. Guys, feel free to jump in at any time. Go right ahead, Jan.
One observation. I mean, it's stunning. We had a lot of difficulty with fixed income ETFs in March and April, right, with big discounts to NAV, a lot of dysfunction in the markets overall, not just ETF related, obviously. But it's just stunning the demand that investors have for liquidity and transparency of ETFs. I mean, it's as if it didn't even happen when you see the inflows, subsequent to that. Both on the fixed equity side, of course, but on the fixed income side is more eye-opening to me. I just would have thought that we would have gotten more questions, and there were questions for about a month, and then the inflows started. So I think Doug's got a really easy job.
Well, why weren't there more questions? What kind of questions were you expecting, Jan?
No, I just think what it reflects is that, questions as to, listen, why is my investment grade fixed income ETF at a 5% discount to net asset value? Or others were well over 10 or 15% discounts to NAV from big fund families. And it reflected the dislocation in the underlying bond markets. But my main point here is investors love the transparency of ETFs when they know what they're getting, and the liquidity. It's just a great, easy way for them to put money to work in a very defined manner.